Hello and welcome back. If you're joining live or watching the replay, I'm Betty Rose Pradhan, founder of BBITS. Yesterday, we talked about how to read your profit and loss like a CEO. Today, we're talking about the report that most business owners avoid, the balance sheet. If your balance sheet is wrong, your tax return is wrong. So let's remove the fear and make this simple. What a balance sheet really is. A balance sheet is a snapshot. It shows what your business owns, owes, and what's left over at a specific point in time. It is not about performance. That's the P&L. The balance sheet is about position. Think of it as your business's financial health check. Be honest. Have you ever opened your balance sheet and immediately closed it? Type me in the comments. No judgment. The three parts of a balance sheet are, let's break it down. Assets. Assets are what your business owns. This includes bank accounts, accounts receivable, equipment, inventory. If your bank balance here is wrong, your books are wrong. Liabilities. Liabilities are what your business owes. This includes credit cards, loans, taxes payable. Credit cards are not expenses. They are liabilities. Loan balances must match statements. Equity. Equity is the difference between assets and liabilities. This includes owner contributions, owner draws, retained earnings. This section tells the true story of your business over time. Why balance sheet errors are dangerous. Most IRS notices I see start with balance sheet errors. Common problems: negative bank accounts, credit cards with no balances, loans expensed incorrectly, owner's draws coded as expenses, retained earnings that don't make sense. These errors affect your profit, your taxes, your credibility. If the balance sheet doesn't balance, nothing else matters. Does your balance sheet make sense or confuse you? Type sense or confused. How the balance sheet connects to taxes. Your tax return pulls information directly from your balance sheet. This includes asset depreciation, loan balances, equity changes, prior year activity. If these numbers are wrong, deductions can be lost, income can be misstated, returns can be delayed, amendments become necessary. Tax prep cannot fix a broken balance sheet. When you should pause before filing. Pause before filing if bank balances don't match, credit cards show zero but aren't paid off, loans were expensed, equity doesn't make sense, you don't understand retained earnings. Confusion is a signal, not a failure. At BBITS, balance sheet review is a critical part of every cleanup and tax prep. We don't ignore it. We correct it. That's how returns stay accurate and defensible. If your balance sheet doesn't make sense, pause before filing. DM me balance or book a discovery call using the link in my bio. Clean books require a clean balance sheet. Tomorrow, we'll talk about what your tax preparer actually needs from you and how to avoid delays. Thank you for being here. I'll see you tomorrow.